a statistical analysis of all-time highs. Basically, everyone's been talking about all-time highs. Everybody's been talking about the all-time highs in the market and in Nvidia and a bunch of these other tech companies. And so I wanted to do like a little bit of a statistical analysis to say like, well, okay, if we hit all-time highs, what can we maybe expect based on average historical behavior? So I thought that would be kind of interesting because let me tell you something. It is a big pet peeve. And I hear this all the time when people say, oh, Nvidia is at all-time highs. I'm going to be a contrarian. It has to go back down. Like that is, I understand the logic, but do the statistics actually validate that? Because what we've seen in very strong bull markets is that we can just keep hitting all-time highs over and over and over again. And while we might have a correction at some point, that doesn't necessarily mean that it is tradable. So I wanted to do a little bit of an investigation about this. I just wanted to show some really interesting stats, or at least stats that I found interesting. So to set things up, all-time highs of the market. Everyone's talking about them. They have completely dominated, conversations in 2024 in the financial space. And I want to know, we're hitting all these all-time highs. What does this mean for traders? Do all-time highs signify that a reversal is more or less likely? So let's take a look at all-time highs from a statistical perspective. And we're going to focus on the S&P. Little bit of context for this year. So the S&P, and I'm going to be using SPY for a lot of these slides just because it is more tradable than other types of assets that track the S&P 500. But SPY passed all-time highs 33 times year to date, or about 13% of the time in 2024. So that's kind of a lot. That's 13% of the days in 2024. SPY has just been surpassing its all-time highs, which is a very, very strong year for the market. But I wanted to know, okay, so like, how does this stack up historically? And what we can see on this chart is like a labeling of every single time that SPY passes all-time highs. So we can see a huge clustering leading into the dot-com bubble, and then it's selling off. We can see a little bit of some occurrences leading into 2008. And then we see like 2014 onwards, where we just had this crazy bull run with the 2022 bear market and the COVID crash sort of mixed in there. We've been having a very strong year, but what does that sort of look like, or how does that stack up historically, even though we're sort of like halfway through the year? So I went back to 1993, so that's all the data that we had for SPY. Going back to 1993, the strongest year for the SPY was actually 2021. And it surpassed all-time highs 71 times and grew by nearly 28%. It was the strongest year for SPY that was recorded during this time frame that we tested. 71 times, 28%. It grew 28% in a year. And so we're halfway through the year. We're already at 32 times, right? So like we're, on track to maybe get up there in terms of like one of the strongest bullish years sort of recorded, although there's still a lot of time left, right? So the second strongest year was 1995, where it surpassed all-time highs 67 times. If we keep going at this rate, we could be up there with like the second, third strongest year in SPY recorded, which is kind of bonkers. But another interesting thing to sort of point out is that the longest dry spell, which is kind of interesting, was from 2000 to 2007. So we've had just such a bullish market for the past like couple of years that imagine the market just not doing anything, not necessarily not doing anything, but just being like not hitting all-time highs for a 7-year period. That feels like a really long time. So I just wanted to point out that dry spell from 2000 to 2007. And a little bit of an aside, a historical note, is that when we look at the index itself, so GSPC going back to 1927, most of our talks are not going to be focused on this because this is not tradable. But for a long-term back test, if we want to go back to 1927, the longest dry spell was actually 1929 to 1954. 1929 to like decades. But looking at a statistical perspective, we can see like, okay, so 2024 has clearly been a strong year for the market. And we're not even done with 2024. A lot can still happen. But so far, it's been a very strong year. So does that indicate that a reversal is more likely in the near future? That's kind of what I wanted to test. And I wanted to use the S&P as a benchmark for that. So it's important to note that there are different types of market growth. Using all-time highs is not really a way to really validate whether or not we're in a bubble, statistically at least. But I wanted to note, there are different types of growth in the market, and we're going to kind of neglect that, all those other indicators. We're really just going to look at all-time highs. So we're going to look at SPY from 1993 to present. So from our first little analysis, we want to know how likely are S&P all-time highs? Like how likely is it for SPY to surpass all-time highs just overall? But SPY only has surpassed all-time highs 7.8% of the time. Just overall, on any given day, there's a 7.8% chance that SPY is going to surpass all-time highs. So overall, it's actually not very likely. But what we noticed from looking at this chart is that bullish market trends tend to be very strong. So these kind of like all-time high occurrences tend to cluster together. And in fact, if the market reaches an all-time high today, there's an 88% chance that it's going to reach all-time highs again at some point within 2 weeks, based on at least historical trends. And on average, there were actually about 3.5 days when, on average again, 3.5 days when, all-time highs were surpassed again within those 2 weeks. So looking at very short time frames, we can see again that these all-time highs, these very, very bullish market conditions tend to cluster together. So if the market hits all-time highs today, there's an 88% chance that it hits it again within 2 weeks. But what I found really, really interesting is that when you actually look at how the market moves over slightly longer time frames, like 1, 2, and 3 months after this all-time high, growth actually slows, which I was very surprised about. So here we have the average percent change in the S&P 500 after it hits an all-time high, 1, 2, and 3 months after this happens. And then we also want to look at just the average percent change in general. So regardless of whether or not the S&P is currently at all-time highs. So we want to compare those two percentages and see what the difference is. And then we also want to look at the probability of just the S&P just generally going up within 1, 2, or 3 months, or at the end of 1, 2, or 3 months after it hits all-time highs, and then just compare it to just like the general monthly change in the S&P 500. And what we can see is that even though all-time high events tend to cluster together in very short proximity to each other, when we look at these sort of longer time frames, like the performance over slightly longer times when this happens, we actually see slowdown in growth following on average. So on average, in any given month, the S&P, for 1 month, the S&P grows by about 0.8%, which makes sense when you consider like the S&P on average returns like 9, 10% in a year. Totally makes sense. So 0.8% is just on any given month, on any given monthly interval. That's how much the S&P tends to grow just in general. But when you have an all-time high, that percentage actually drops down to 0.15%. So on average, it still grows, but just at a much slower rate than how it grows in general. And we can also see that the probability of an increase is like a little bit lower, although very similar. When we look at 2 months, we also see this slowdown continue. So on average, on any given 2-month period, the S&P grows by about 1.6% on average. But after an all-time high, it's about 0.9%. When we look at 3 months, it's 2.4-ish% for any given 3-month period, and then closer to 2% after we have an all-time high. So on average, we're still growing, and it's important to remember that we have like recessions mixed in here, we have sell-offs mixed in here, we have like the consequences of bubbles mixed in here as well. But on average, we're still growing, it's just at a much slower rate, which kind of makes sense. So even though we're hitting all-time highs in very close proximity to one another, over like monthly timeframes, it doesn't necessarily mean we're actually going to see a significant sell-off or rally on average. And again, it's very important to note that this is not Nvidia, this is not GameStop, this is not Tesla, this is like a broad market index. Generally, when we want to test one thing, that's a good underlying to test it with. So when we want to test like a market behavior, or when we want to test something in general, like whether or not all-time highs can be used as a trading indicator, it's generally better to use something that's like a broad market index rather than something that is prone to potentially like super speculative behavior or bubbles or GME squeezes, right? That kind of stuff. So these statistics would certainly look different if we were looking at Tesla or we were looking at Nvidia. And it's important to remember that. So just to kind of conclude, so this analysis suggests that all-time highs tend to cluster together in very close proximity to one another, but over like the span of months after these happen, market growth actually tends to cool on average. So it still grows on average. Again, we're looking at all these average performances over the next couple of months, but it tends to be at a much cooler rate than just any given month in general. So this behavior, in my conclusion at least, is that this behavior is not necessarily strong enough to justify using all-time highs as a trading indicator alone. And there have certainly been instances where market growth has appeared to be highly speculative or unsustainable, such as the dot-com bubble or 2021, which again was like close followed pretty much immediately by a bear market. So we clearly see that these like abnormal or like unsustainable market conditions tend to happen that might potentially be predictive of an upcoming reversal or a correction. And I don't like using that word, but that might be indicative that a correction or a reversal is more likely. But just from these kind of preliminary tests, it seems like that all-time highs alone are not a good way to gauge that behavior or to gauge whether or not this is more or less likely. So I think they're definitely interesting to watch. We've seen that like there have definitely been stronger years, right? At least since 93. Yeah. It's interesting to watch. But in terms of using all-time highs as like a very strong contrarian indicator, I think that like speculative behavior, like bubbles, are much more complex to classify, and I wouldn't use this, at least alone, in order to do that. It's like we don't really have any good indicators for bubbles. Like if, in terms of assessing whether or not we're currently in a bubble, you usually don't know until after it already pops. So you could certainly make that argument. But bubbles can go on for years before they actually correct. And then the correction can also last for years. It's just difficult to make sort of like active trading or even like passive trading decisions around something like that. Hopefully it changed at least how we maybe think about these in terms of potentially using them for a trading indicator. So thank you guys for watching.